Hey, folks, today I'm asking a really tough question. The one that Wall Street doesn't want you to ask. Are stocks overpriced? Or are we just pretending valuations don't matter anymore? From AI hype to stock market trading higher than it did during the dot com bubble, things are looking really frothy. So I've got some numbers that'll make you double take and some strategies that help you stay grounded. Stick with me. We're diving in right after this. Hey there, Chris Hobart here, the Wealthologist. Now, I've got a question for you. Are we about to learn the hard way that valuations still matter? Because from where I'm sitting, the market's starting to smell a bit like 1999. Not in a fun, nostalgic way, though. See, here's the deal. First Trust just released a report showing the S&P 500 is trading at 3.23 times their sales. Uh, Let that think in. That's not just expensive. That is more expensive than during the dot com bubble back in the late 90s. The 25-year average, well, 1.7 times. So, yes, we are in some very rare air, and history hasn't been kind to this level of hype. Now, look, price to sales isn't the only number that matters. But when all the key metrics start flashing red, from price to earnings to discounted cash flow models, it's time to start asking real questions. Now, according to First Trust Capitalized Profits model, which adjusts for the 10-year treasury yield, the market is between 20 and 40% overvalued. I got to tell you, that's no small potatoes. Now, what does it mean in plain English? It means if nothing changes, if earnings stay flat and interest rates hold, the market could drop 20 to 40% just to land back in what we call fair value. Now, before we all go jumping out of windows, I want you to take a breath. I'm not saying a crash is guaranteed, but I am saying the math, it doesn't lie. And right now, the math is shouting at us. So, what's driving the crazy climb? Oh, a couple of letters: AI, artificial intelligence. That's become the latest market darling. And listen, I'm not anti innovation at all, but when investors start treating AI like it's magic money machine, well, we've got a problem. Now, right now, the 10 top tech stocks, most of them riding the AI hype train, they make up nearly 40% of the entire S&P 500. That is not diversification, folks. That is obsession. It reminds me of 1999. That's actually when I first got interested in the stock market. Folks were saying the internet would change everything. They were right. It did. But that didn't stop investors from losing their shirts chasing vaporware companies that had a .com in their name and nothing else. The big question now is AI creating new economic value, or is it just cannibalizing existing revenue streams? Are we seeing real productivity gains or just repackaged tech with a fresh label? And I think the jury's still out on this. Meanwhile, the economic picture is a bit murky as well. You see, real GDP, it's crawling along at just 1.4% for the first half of the year. Job growth, it's slowing. Consumer spending, which is important, it's starting to cool. And yet the stock market is acting like we're in boom times. Now, some people are betting that if things get rough, the Fed are going to cut rates and magically boost valuations again. But if your entire investment thesis is the Fed will save me, that's not a strategy. That's hope. And hope, as they say, is not a plan. So what should you be doing right now? Smart investors in times like this is what I tell my clients. First, rebalance. If tech stocks have ballooned to take over your portfolio, it may be a good time to trim. Ride the winners, sure, but don't let them steer the entire ship. Second, dig into valuations. Don't chase performance. Look at actual fundamentals: earnings, sales, debt, free cash flow. If the numbers don't add up, neither should your investment. Third, I want you to diversify in underpriced sectors. There are still areas of the market that look attractive, just not the ones getting all the hype in the headlines. Number four, I want you to stay disciplined. Emotion is the enemy of smart investing, especially now when every headline screams AI and fear of missing out is lurking around every corner. Listen, I get it. It's easy to believe that this time is different, that AI really is a game changer, that interest rates don't matter, that the market can only go up. But history has a habit of humbling those who ignore it. Back in 1999, people said recessions, they were a thing of the past. They were wrong. Uh, Today, people are saying valuations don't matter. And I think they're wrong too. So I'm going to leave you with this. Are we smarter than the last generation of investors, or maybe just more distracted? Drop your thoughts in the comments below. I'd love to hear what you think. I'd also love your perspective on, do we think that that dip is coming, and what your perspective is. Now, also, if you're not sure where your portfolio stands in all of this, or whether you're chasing hype or sitting on something solid, I'm always here to talk. Just let me know. I also like this video, share it with someone that you know is all in on tech and might need a little bit of a reality check. And also subscribe for more insights that cut through all the noise. I'm Chris Hobart, the Wealthologist. I'll see you next time.